All right, let's get right to the heart of it. What does it really mean to own a piece of a company? We're going to be talking all about equity today. You know, the big idea behind every single stock you've ever bought or maybe even just thought about buying. Let's break it all down.
So let's kick things off with a pretty fundamental question. When you click buy on a share of stock, what are you actually getting? I mean, is it just a number that goes up and down on a screen, or is it something more real? Well, to figure that out, we've got to go back to basics and look at the company itself.
Okay, so if you want to understand a stock, you first have to get your head around the thing that's actually issuing it, right? And that's the corporation. And the very first thing you need to know about a corporation is, honestly, a little weird. You see, in the eyes of the law, a company is basically a person.
Yep, you heard me right. When a business files this document called the Articles of Incorporation, it's like it's creating a brand new, separate legal person. And this legal person, it can own stuff, it can sign contracts, it can even be sued, and it's all completely separate from the actual human beings who own it. So you might be asking, why go through all that trouble? What's the point? Well, it all boils down to one incredibly powerful idea: limited liability. This is huge. It means that as a shareholder, you are not personally on the hook for the company's debts. So if the business goes belly up, creditors can't come after your car, your house, your savings, none of it. And that protection, that's the main reason this whole structure is so popular for raising cash.
All right, so now that this corporate person exists, it needs money to grow, right? It has two main paths it can go down. It can either borrow the money, we call that debt, or it can sell off little pieces of itself, and that is equity.
So let's look at those two paths. On one side, you've got equity. This is where the company sells shares of stock, and if you buy one, congratulations, you're now an owner. The official term for you is a residual claimant, and hang on to that phrase, we'll get back to it. Then, on the other side, there's debt. This is just a loan, really. Think of a bond. The people who lend the money are called senior claimants, and believe me, that word senior makes all the difference.
And this is where the rubber really meets the road in terms of risk. Imagine the company goes bust. There is a very strict pecking order for who gets paid back. The debt holders, the bondholders, and creditors, they are first in line, no question. Then you've got preferred shareholders. And way down at the very bottom of the list, that's the common shareholders, the owners. They get paid last with whatever crumbs are left over. That is what residual claimant means. It's the huge risk you take for the chance at a huge reward.
So let's zoom in on that last group on the ladder, the common stockholder. Because honestly, this is what pretty much everyone thinks of when they hear the word stock. This is your actual, real, slice of the pie ownership in the business.
So where do these stocks even come from? Well, their story begins in the company's original rulebook, the corporate charter. This document sets the absolute maximum number of shares the company is legally allowed to create, ever. It's like setting the total possible supply from day one. So for our example here, let's say that's a cool 1 billion authorized shares.
But, and this is a big but, a company almost never just floods the market with all those shares at once. No way. Instead, they'll just sell a fraction of them to the public to raise the money they need. We call these the issued shares. So out of that potential pool of 1 billion, maybe they only issue, say, 10 million to investors.
Okay, now here's where it gets a little more interesting. Sometimes a company will go out and buy back its own stock from the open market. These shares are called treasury shares. Why would they do that? Well, maybe to show the market they're confident or to try and boost the stock price. Now, these shares are technically still issued, but because the company itself is holding them, they're kind of in limbo. No voting rights, no dividends.
And all of that brings us to the number that really matters to you as an investor, the outstanding shares. The math is simple. It's just the issued shares minus any of those treasury shares the company bought back. This is the actual pool of stock that's being held and traded by the public every day. It's the number you can actually buy and sell, and it's what determines your exact ownership stake in the company.
And look, owning one of those outstanding shares isn't just a passive thing. It gives you actual rights. I'd argue the most powerful one is the right to vote for the board of directors. You know, the people who are actually steering the ship. You also get a claim on the company's profits through dividends and, like we talked about, that residual claim on everything left over if the company ever shuts down.
And you know what's interesting? How your vote counts can make a massive difference. With what's called statutory voting, it's pretty simple. One vote per share for each open board seat. This system really benefits the big fish, the major shareholders. But then there's cumulative voting.
This lets you take all your votes and pile them onto a single candidate if you want. It's a game changer, because it can give the little guys, the smaller shareholders, a real fighting chance to get someone on the board who represents them.
Okay, but common stock isn't the whole story. There's another type of equity out there called preferred stock. The best way to think about it is like a hybrid. It's part stock, part bond. And most importantly, it comes with a kind of VIP pass when it's time to get paid.
And preferred stock isn't just one thing. It comes in a few different flavors, each with its own special feature. We're going to really dig into cumulative in a second. But you might also see callable, which means the company can buy the stock back from you. Convertible means you can trade it in for common stock, and participating stock might even get you some bonus dividends if the company does really, really well.
So let's really focus on that cumulative feature, because it's a big deal. Let's say a company promises a 10% dividend on its preferred stock, but then it has a couple of bad years and misses those payments. Now it's year 3, and things are looking up. If the stock is cumulative, that company must pay all the missed dividends. So 10% for year 1, 10% for year 2, plus 10% for the current year. That's a 30% payout. And they have to do all that before a common stockholder gets a single dime. But if it's non-cumulative, they only have to worry about the current year's 10%. See the difference? It's a huge layer of protection for those preferred investors.
All right, we're almost there. Let's just quickly touch on a few other things you might bump into in the world of equity. Think of these as special tools in the ownership toolkit.
Okay, so you've got rights and warrants. They both give you the option to buy stock, but they're used for totally different reasons. Think of it like this. Rights are a short-term deal just for current shareholders. It's the company's way of saying, hey, we're selling new shares, but we want to give you the first chance to buy them at a discount so your ownership percentage doesn't get watered down. Warrants, on the other hand, are a long-term play. They're often thrown in as a little sweetener to make a new stock offering more attractive, and they usually let you buy shares at a price that's actually higher than the current price, betting that the stock will go up.
So what if you want to own a piece of, say, a cool tech company in Japan or a big car manufacturer in Germany, but you don't want to deal with foreign stock exchanges? Well, that's what ADRs are for. An American depositary receipt is basically just a certificate that trades on a U.S. exchange like the New York Stock Exchange, but it represents shares in a foreign company. It just makes everything so much easier. You get to invest all over the world, but you're doing it all in good old U.S. dollars.
So when you boil it all down, what's the big takeaway here? It doesn't matter if it's common stock, preferred stock, or one of those ADRs. The core idea is exactly the same. You are never just buying a ticker symbol on a screen. You are buying a tangible piece of a business, you're getting a real claim on what it owns and a real say in where it's going.
And look, understanding all these rules, from that limited liability safety net, to your voting rights, to where you stand on that payout ladder, that's not just trivia. That's the bedrock of smart investing. It's what changes you from someone just watching the market to a truly informed owner. So with all that in mind, the only question left is, what kind of owner are you going to be?